Hello, everyone. My name is Yvonne Bendinger-Rothschild. I'm the Executive Director of the European American Chamber of Commerce. And I would like to thank all of you for joining us for our quarterly economic update. I'm here with Willem Kooi and Ben Carlina, both with the European EU delegation to the United States. And we're going to unpack the autumn 2025 forecast, what it means for the US, what it means for European business investment, and overall the transatlantic economy. You will see on our, there's a recurring theme today, which is Europe is emerging from stagnation and increasingly ready for business. The theme of our podcast today is when the going gets tough, the tough get going, and that's definitely the case from in Europe. Willem, you just got back from Europe. What's the mood?
Yeah, so thanks for that, and great to be here again, Yvonne. So I came back yesterday evening, so I suppose that's as fresh as I can bring the news. And the mood is much better. I mean, where I think people felt in Europe a bit orphaned in spring, and like we need to get our act together. Now you see really things happening in Europe. For instance, when you look at the AI, so only in early 2025 earlier this year, there was the idea of, well, we need to catch up with AI. And already now there's 500 million being invested in AI gigafactories. That's just one thing. But I mean, it's not just me saying this, but it's also, if you look at the forecast in which we're going to talk about a lot today, if you look at investment, just look at investment, equipment investment. And I made the calculation. So the projection from 2025 to 2027, so the 3 years that we're talking about in the forecast, they have upgraded investment, in particular in equipment, by almost 7 percentage points. I mean, this is huge, and we'll talk about it later. But the mood has changed a lot from, so to say, oops, what's happening here, to yeah, we can get our act together, and this is a new constellation, maybe not the one we want to be in as a EU. But this is where we are, and we need to work on all these fields, on the single market, on how to remain competitive, but still have fair competition, be open to fair competition, and at the same time work with where we are right now. You've seen the new free trade agreements that we've entered into. So yeah, Europe is open to business, as you said, never before, especially if you look at it in a relative sense. Thanks.
Okay, very good. Ben, as the senior economist at the delegation, what are the growth expectations that are coming out of this report?
Well, maybe, first of all, thanks for having me again, Yvonne. It's always a pleasure to be here. And maybe I will see if I can share my screen and so that we can start this. There we go. So we can just get in. So these are the key messages. So basically, as you know, Europe has been through a couple, the last time we were here in the spring, we were talking about how Europe was still trying to emerge from these shocks due to the, first COVID and then the war. And then we have this deterioration of international trade relationships that started last year. And so, as Willem was alluding to, the mood wasn't that great. But the key messages from the forecast is that, compared to what we were talking about in the spring, we've beaten expectations. The first 9 months of the year has seen better than expected growth. Looking ahead, we expect that growth to continue, not, gangbusters growth, but steady, moderate growth that is based on domestic demand and domestic sources of growth. We've got a very stable macro environment where, inflation is basically at the 2% target and is forecast to stay there for the forecast horizon. And all of, the fact that we're back to 2% is good news for the European consumer because they've seen their purchasing power be eroded by higher than expected inflation. And that has had, conflicting impacts on the EU economy because on the one hand it's constrained household spending a bit, but on the other hand there was this big downward debt to dynamic in the debt to GDP ratios. So the fiscal situation has improved a lot. But the big picture is still that Europe has very large investment needs, especially for defense and IT. And as Willem alluded to, there's a lot of attention on that now and a lot of focus. So we do expect there to be more fiscal support that is going to boost investment in these areas and a few others. And that is really going to drive growth, despite the fact that we've still got a very uncertain geopolitical environment. Trade policy is not totally sorted. And that means because the external environment is still a little bit unstable, domestic demand is going to be the focus, and also like structural reforms and more public investment. And this is what's going to drive things.
It's interesting. Thank you for that. So it's not about explosive growth. It's about resilient stability and, getting back on track. You mentioned tariffs, and I think on the next slide, you're going into that. Can you elaborate a little bit on that, how it affected the EU economy? But we know how it's affecting the US economy, but how is it showing up or how is it influencing the European economy and
Right.
forecast?
Yeah, so as everybody knows, Europe is a pretty open economy, and so it's not good for growth when net exports are a drag, and that's what's been happening. But it's also maybe not as bad as a lot of people think because there's a while we don't like the fact that U.S. tariffs have gone up, there are some kernels of good news in there. So one thing is just the average effective tariff rate. This is a number that you get from backing out how much customs revenue the U.S. Treasury Department, the IRS, has collected on imports. And there's been a lot of confusion because various tariff announcements they've changed, and sometimes they've been higher and lower. But like as things stand right now, the average effective tariff rate for EU exports to the U.S. is about 10%. This is a bit higher than we were forecasting in the spring. And globally, trade barriers are much higher than they were before. But it's also, lower than some of the headline numbers that people have seen, like, a 15% tariff. There's a lot of carve-outs, and aircraft and pharmaceuticals are currently exempted from U.S. tariffs. We hope that that's going to continue. And the chart on the right here that I'm showing you shows the relative level of tariffs. And I think this is an important point that we should emphasize, that U.S. tariffs have gone up for all imports. But in fact, the EU enjoys relatively lower tariffs compared to countries like China and Vietnam and Thailand. And in a weird way, that gives European exports to the US a comparative advantage because they're not as burdened by as high tariff rates. Now, it's also true that within the EU, there are some differences depending on which member state you're talking about. Germany, for example, has this average effective rate of 10%, but it exports more than, say, Malta does to the US. So the hit on growth to Germany is a little bit worse. But the main thing is that right now China is facing an effective tariff rate of over 30%. ASEAN countries are 20. That's significantly higher. And in the long run, this could potentially lead to a relatively large shift of merchandise exports away from the US. This is also something that we're a little bit worried about because on the one hand, it means that EU exports to the US might do better, but it also means that the Chinese and other companies that are, have excess capacity, overcapacity, might try to export some of those goods to Europe. And so That's something to keep an eye on in the months ahead. I don't know, Willem, if you want to add anything here.
Yeah, no, I mean you're absolutely right about that relative position, but also at the same time the pressure on competitiveness that you face, right, within Europe. But on top of that, and one of the things is that, so coming to the title of this presentation is Europe is open as business to business as never before. So we're working on the simplification and trying to bring down the administrative burden in the EU, on in particular on sustainability reporting. But also this is something that we will also bring forward to our next budget, which is called MFF, Multi-Annual Financial Framework, which spans 2028 for 7 years, and then 7 years, 2034. But the thing is that what we hear, and this is where the mood is not so good actually among European exporters, is when it comes to those that have to report on steel and aluminium contents. And this is really a serious issue in the EU, and there are those exporters. For instance, I read in the Frankfurter Allgemeine that actually Krone, which is a big trailer builder, actually is planning to stop exporting to the US because of these impossibilities in reporting on steel and aluminum requirements. Of course, on top of that, you also have the de minimis changes. So these are really hampering. So beyond, so to say, what the tariff is, and which might actually, in a strange way, bring us in a position that we don't want to be, but we are, in the sense that, you know, we have a relative competitive advantage. That actually there is more to the trade story, which is about administrative burden, which I would personally never have associated with the US, because it's a real detriment to the business environment. Thanks.
Yeah, I mean, you're referring to the percentage of steel, you know, that is part
exactly.
of a product, and then you need to define it exactly. You know, is it 3%, is it 5%, and etc. That makes it like really, really difficult. I mean, in Kohn's case, it's all steel, no? Aren't these containers 100% steel?
Yeah.
Yeah. That is,
and if you now read the European press, then I mean, very regularly come across stories of individual companies that say, okay, now we can't export anymore. And of course, that's not good, because it brings you in a situation where, you know, you have shielded markets which are if maybe less choice to the consumer at a higher price, which is.
But, you know, this is also an issue for American companies, because supply chains are so integrated that a lot of American firms are having to try to figure out what percentage of their widget, whatever it is that they make, comes from foreign produced steel and aluminum. So, you know, this administrative burden is not just falling on European exporters, but on anybody that does business in the United States.
Yeah, and but it also, like you said earlier, it ties all together, because you know, I mean, the parts that are coming into European products may be coming from one country, then you know, it comes together is put together in Europe and then sent to the US or sent to Canada. Can you send it through Canada, and then you get another a Canadian tariff, etc. So this is kind of like an you know, a Tetris of tariffs that's coming together, and really hard to get a handle on. I mean, like Willem just outlined.
Yeah, maybe I can highlight another interesting feature of the report. We're talking about the forecast report here. So the effect of the tariffs and on EU. And colleagues have made a nice, very interesting box about this and I recommend reading it. It's actually, it depends very much on how important the role of the US dollar is in world trade. So the costs become higher when the US dollar is more important. Or to say it the other way around, you know, if you're hurting trade, then you're hurting the position of the US dollar, right? So that is a very nice book. I recommend reading it and looking at the difference, so to say, between when there are flexible exchange rates and the situation where exchange rates effectively are the US dollar, where the others actually effectively use the US dollar.
Yeah, it's interesting because I was just going to ask you how this all fits into the broader macro environment. So that's an interesting aspect of this. Who wants to take a lead on this on the next slide that
Yeah,
we're looking
I
at?
think I can maybe the thing we should do is start with the macro environment
Yeah.
and compare and contrast a little bit with the US and the EU. So as everybody knows, for the past couple of years, the US economy has been outperforming. But the question is, when you look under the hood, what is really driving the growth in the US and what's been happening? And I should say that the forecast for the US that we have from the commission is that growth is forecast to decline, to slow. In 24, the US economy GDP grew by 2.8%, and we expect it to be about 1.8% this year, and then stabilize at about 2% for 26 and 27. And the question is how to make sense of this data. And in the first half of the year, there was really a confusing data. There was a lot of volatility. In the first quarter, you actually saw GDP contracting in the United States, followed by this big rebound. And that was happening because a lot of importers saw that tariffs were coming, and so they tried to front load as many of their orders as possible so that they could import as many goods as possible without having to pay the tariffs. And so, as you know, imports, when you do the growth, when you do the GDP accounting, net exports, if you have a trade deficit, that lowers growth. And so the surge in imports in Q1 is basically the reason why you saw this strange contraction, because in fact, private sector demand didn't change that much from Q1 to Q2 in the United States. So that's one of the reasons why there have been these strange figures. But underlying it all, you still have seen a slowdown in household spending. And what a lot of the growth in the United States appears to be is this enormous AI investment boom.
Yeah.
And that's something that is a question. Like, will this continue? Obviously, AI is important. Obviously, it's real. There's going to be some companies that benefit from the transition to AI and make huge amounts of money. And I think that you've seen a lot of enthusiasm about that in U.S. equity markets. But as far as what that means for macro, it's really the wealth effects from all the increases in equity indices that have been supporting US consumption. If you break down household spending, it's really like the top 20, 30% of the income distribution that has been driving a lot of the growth in spending. And, regular middle class people, they still have jobs, they're still doing okay, but they're not feeling as confident and they're not spending as much. The growth in household spending isn't as much in lower parts of the income distribution. So if you were going to have a stock market correction in the US, which I'm not predicting, but is always possible, you could see an impact on growth because household spending could really decrease a lot if people suddenly feel like, oh, I don't have as much money in my 401k, I don't have as much money in my investment account, I'm going to have to pull back a little bit.
Yeah, but I think this, I mean, 30 or 40% of Americans are part of have investments in the stock market. I think it's
No,
more
it's
like
more. It's more than that because most
Yeah.
people have investments through their pension schemes.
Oh, okay. But I think it's the overall sentiment that is going to decrease consumer spending. If the companies feel shaky, they may lay people off, and there's an overall negative impact on or not
Right.
negative
We
impact,
haven't
but
seen major job losses
yeah,
yet, but it's a
yeah,
possibility. And the other thing that we know is that inflation, unlike in Europe, inflation in the US is set to rise because you've only seen part of the pass through from higher tariffs make its way through into higher prices for goods and services. And so most economists think maybe about a third of the pass through has happened already. So inflation is, at least in the short term, going to increase in the United States, and higher costs for all kinds of automobiles and things like this are another thing that could constrain U.S. spending and could constrain, confidence in consumer confidence in the U.S.
Yeah, I agree 100%. And then there's the whole discussion with, the circular investment among the AI companies, and if this is real investment or it's just like NVIDIA paying people to buy their chips and promises being made into the far-flung future. So that's also yet to be seen if these numbers are real. But we're all going to monitor that. Looking, you mentioned the upper income households, that they are keeping up the spending. What about labor? We haven't seen unemployment numbers rise, but I think the question is also, in order to really support the economy, all the build-up with the data centers, etc., we need a different type of workforce, not people like us who sit in the office, but welders, electricians, crane operators. Is there a concern in the U.S. that this is slowing growth?
Yeah, I think there's a lot of confusion about this because we've seen a huge shock to labor supply with lower immigration over the past year. And sectors, like the construction sector that you mentioned, have been particularly affected by this. And it's a little bit, this is sort of the conundrum that the Federal Reserve finds itself in. It knows that inflation is still above target. It wants to get inflation back down, but it's also worried about, is there real weakness in the labor market? And the government shutdown delayed a lot of data. And so, it's not that the Fed is flying blind, but the outlook is a little bit fuzzy. And so we'll have to see in the coming months, like how much demand for labor has also fallen, because it looks like it has fallen a bit. And there might be mismatches in terms of some sectors are feeling it more than others. So this is to be seen. It's a question mark.
Yeah. But let's get back to Europe. What's the situation there? Investment in, where's the investment? There's investment across the European member states. It's going into infrastructure. I just got back from Germany a couple of weeks ago, and they're building roads like there's no tomorrow. Where else? No, it's really incredible.
They're building up for tomorrow.
Yeah, exactly. Quite literally. Where's other spending going?
Yeah, I mean, you mentioned Ben, you want to take this?
Go ahead.
No, I'm fine if you're take. But I mean, of course, you mentioned Germany, Yvonne, and Germany is a key part of the story, right? I mean, we've had 2 years of stagnation in Germany, but now it's coming back to growth. And much of it is actually from the public finance spending, and this has been really good, almost perfect. No, perfect that we can hardly say if you have to look at the public finance, but it has been very good timed, and it's been very good pointed to certain sectors. So first of all, it's been timed in a way that Germany economy was hit by the energy price rise from the Russian war on Ukraine. So it was under pressure, that sector. So it was a good, at the macro level, it was a good timing. And then it is also a good timing, or the sectoral timing is also, or sectoral focus is also good, in the sense that it's infrastructure and defense, which are, first of all, there is a gap, huge investment gap in Germany, and that will come already in 2026. And you saying it's already happening now. And then we will get later the defense spending, which is also very good, because, for instance, the fallout has been in quite a bit in the car manufacturing, but also in particular cars are imported in Germany, of course. And so what you see is there that, for instance, some of the fallout in the manufacturing sector is being taken up by defense spending, which is in equipment. Talking about where the money goes, it is in equipment. And being in Europe, I heard the example of a Volkswagen manufacturing plant, which was being put on ice. But then with defense demand for defense goods, actually it was brought back into production. So that's the point, so to say, about so to say the timing, the sectoral allocation, and I think the third point we should never forget is the urge for reforms in Europe, right? So as to make the European economy more flexible and competitive, and this is also attached to it. Of course, we've seen that in the past with the recovery fund. We will see it in the future with the MFF. But payouts from the EU are conditioned now more and more on reforms. And but actually, this is something that the German government was already planning to do, because for this infrastructure they will need to change permitting, which was one of the bottlenecks for a long time in Germany. But okay, oh yeah, and then on the labor market, you were talking about for the US. Before I take too much of Ben's time, but the labor market, what I always, so the European labor market is still going very solid. We don't see that high in employment growth. But sometimes you hear these discussions, America versus the US, and so to say the attitude towards labor work. And I think we should then always refer to also two figures. So it's a kind of to nuance it, which is 60-75. So in America, it's about the labor force participation is about 60%, which means that 6 to 10 out of 10 persons in the working age are actually economically active. In the EU, that is 1/4 higher, so 75%, and this is actually going up in the forecast horizon. So this is also going to help boost domestic demand, which will be the huge driver in Europe. And then coming back to what Ben said about the real incomes, one of the questions among policymakers is that, you know, on the one hand, you see this high savings rate, so people not spending, but you also see this real income, which is actually kept up quite well and has been boosted in the last year or so. But if you look at surveys, is what people find in the households actually that they think they underestimate the real income growth. So that can deliver over the forecast horizon as well. Sorry, Ben, to take so much time, but I was just, you know,
no, by all means,
coming back from Europe. I thought I'd give it all.
But maybe I can add just a few numbers just to ground this. You know, and first of all, let me just say let it not be said that we are too optimistic about Europe, because growth this year is about 0.3 percentage points higher than we forecast in the spring. So we were too pessimistic when we were doing the spring webinar with you, Yvonne. And so I apologize for that. But and while it's true that you know, some of the better performance was because of this front loading of exports to the United States to get ahead of tariffs, the fact that the Q3 numbers showed continued growth, I think is a good sign that, you know, European businesses generally have been able to navigate this challenging global environment. Like Willem said, with, you know, taking old car factories and repurposing them for defense production, things like this. There's a lot of things happening on the ground, and we shouldn't forget that. So, you know, the growth forecast, it's not great, but it's good. It's you know, the Commission thinks that the EU is going to grow by 1.4% for 25 and 26, and then tick up to 1.5 in 27. But this is growth in every EU member state. Every member state is expected to record positive GDP growth for the next 3 years. And that's not bad. And this is because, you know, there's a number of tailwinds. We've already talked a little bit about all the investment, the public investment, which is, you know, another word for fiscal stimulus. But accommodative financial conditions are pretty easy. It's like interest rates are relatively low. It's getting easier to borrow. As Willem said, the labor market in Europe is probably like the shining star of what's really keeping things going. You know, even when people were pessimistic at the beginning of the year, there were not huge job losses. Like, people are still gainfully employed. They're still earning money. They have large accumulated savings. Balance sheets are good. So all of this means that, you know, these are tailwinds that are going to drive growth over the next 3 years. And the public, just to put a figure on public investment, it's going to be about 4% of GDP next year. That's, a pretty good number. It's up from 3.2 in 2019 before the pandemic. Lots of infrastructure investment is coming out the door in Germany, as you mentioned. And so all this stuff is pretty good. And maybe the way to say this is that finally what's happening is that you've got this turnaround in the German economy. Germany contracted in 23 and 24 and was more or less stagnant this year because of, a difficult export market for a lot of German firms. But growth is now picking up in Germany. You're going to get 1.2% in 26 and 27. $500 billion are being spent on infrastructure, more on defense. So that's good news, not just for Germany, but also for all the Central and Eastern European economies that are tied into German supply chains.
Yeah. I mean, it's a strength of the internal market, no? I mean, they're picking up a lot just amongst ourselves. And it's good to know that the German locomotive is choo-chooing again. Do you want to, we have, I was just going to say, do we want to say a little bit more about the employment growth? I mean, I have a follow-up question, if I may, about, Willem, what you just said. The 60-75% 60% of the US labor force is active in the labor market. How does that come? What are the other 10% doing that are?
I didn't. So for Europe or for
Europe
the US?
and between Europe and the US, why is this such a different number?
Right. Okay. So I think there's I was mentioning this in the context of generally the idea that in the US people are more keen to work or more, and then in Europe not so much. But I suppose it's kind of the overall setting of labor market institutions that in the EU you have a higher participation of the labor force, which is also
look. One of the key reasons is the cost of childcare in the United States. In Europe, it's much easier and much cheaper to access. For women who work, this is a particular issue for female labor force participation. You have much more subsidized childcare, which encourages women to participate more in the labor market in Europe. I think that's the main answer.
Interesting. Fascinating. Also fascinating that they have more savings than they think and are actually richer. I think I always think that's a German thing. But anyway,
and I don't want to spend too much time on this slide on employment growth, but just to say, I think one of the things to keep in mind about the labor market is that productivity is set to start increasing for the next 3 years, and wage growth. There was this big increase in wage growth to try to catch up to the higher prices caused by the inflation shock. Now wages are coming down while employment growth is continuing at a moderate pace, and people output per hour is going to start increasing. And this is really where you get to see real benefits in terms of living standards and things like this. So that's another good point. But we can move on.
Yeah. I mean, it's just like some anecdotal observations. Same trip, Germany. It was incredible how many people were eating out, like breakfast, lunch, and dinner. It was the restaurants were full, the coffee shops were full. It wasn't. I mean, that means you have. I mean, if you're going out for dinner, not cooking at home, that means you have extra money to spend.
Yeah.
Inflation. Who wants to take
this is part of the reason why we have extra money to spend is because the price increases have more or less stopped. I mean, Europe's back to target. The ECB has successfully engineered a soft landing, and I think that is really great news and really emphasizes how stable the macro environment is. I don't think we need to get into too many of the details, but there's not a lot of goods inflation anymore. European consumers are not having to pay for higher tariffs. it's generally a pretty good situation. I don't know if you want to add anything on inflation, Willem.
No. I mean, to me, this is if you want to where you want to be as ECB, right? So it's confirming. I think the solid how solid at least one of the institutions is of the EU, which is the ECB. And I think, moreover, so to say, generally, I think that is what is the EU about: solid institutions and a solid framework, and not rocking the boat too much, but building on all the good things, and indeed trying to get it better, do it better, and with the simplification, etc. Yeah. So that's not on inflation, but it's rather on kind of the EU where it is.
But I think it holds true for across the board. I mean, when I was reading the report, it looked like that, I mean, it's like we had this conversation where we're excelling in crisis, but I think we have enough crisis now to really excel and build on, on all the changes we made in the past, and now it's really coming to fruition. I mean, at least was the impression that I got when I read some of the numbers coming in. Government deficits and debt ratio. Yeah, it's one of my favorite topics. Who wants to take that one?
Well, maybe just quickly, I'll start by saying, if you look at the chart on the right, you can see from 2020 this really large decrease in sovereign debt to GDP ratios. It was over 90%. You had basically a 10 percentage point drop in debt to GDP ratios for the EU as a whole. And on the one hand, that's really good for fiscal sustainability for European EU member states. And, given that the historical issues that we've had in the past there, that's good news. But if you're an investor, that wasn't the greatest thing, right? Because you had bought very low yielding sovereign debt assets, and the real value of those investments were eaten away by inflation. Now that we've got inflation back at target at 2%, it means that, on the one hand, it means real wages are improving for consumers, and that's going to be a tailwind to growth. But it also means that there's a stable investment outlook for the EU. And it also means that if there's some other shock, some bad thing happens, the ECB has room to cut. And, that's something they're not facing the same conundrum that the Fed is facing in the US, where the risks to its dual mandate are going in different directions, where it still has to worry about high inflation, but maybe there could be some labor market weakness that they have to respond to. So I just wanted to say that to get that out of the way. But the other part of this story is that there's going to be higher public spending to fund defense, infrastructure, climate stuff, and this is going to be another tailwind.
Yeah, but I mean, you can't have one without the other. On the follow up on the debt ratio, is that pretty balanced across the EU, or are there still some laggards or some?
No, there's big differences. Obviously, countries like Italy have higher debt to GDP ratios than Germany, but this is one of the reasons why the RRF, the Recovery and Resilience Facility, was rolled out, was to, enable countries that didn't have as much fiscal space to continue using public investments that were needed, because all EU member states need to spend more on defense. Everybody needs to make investments in technology, ensuring energy sufficiency and independence. And so, this has been a way that the EU institutions have managed to get around some of the constraints that individual countries might feel.
And to add to that, I mean, sorry, Yvonne, but about the heterogeneity of public debt to GDP ratios, I was positively surprised when I looked at the growth and the public finances data as to how well the southern countries, the Mediterranean countries, are doing actually. I mean, that's in part, of course, we have to be honest, that's in part because they're more reliant on services instead of exports of goods. But it's also because they've gone through this adjustment, and that was really good. And so the Italians but also the Greek and the Spanish governments have really taken their act together, brought their act together, and it is paid. So let's hope for the best for that country, which is now a bit more in a difficult situation, and that it also will again get on this good track.
Yeah, and we should also contrast what's happening with the EU in the EU to the US, where the fiscal trajectory, I think, is going to be an increasing source of concern over the coming years. This is an interesting chart because it shows you the red line is just how much federal debt is outstanding, and it's gotten up to 120% of GDP, which is a pretty big number. But what's even more interesting are the blue and the green lines, because those contrast how fast the economy is growing with how much it costs to service the debt. So borrowing costs in the U.S. have generally been below the level of the pace of GDP growth. And that's a good thing, because that means that you can continue borrowing, you're using it for productive investments, or whether or not you are, it doesn't matter so much, because over time, you're not going to get trapped into this negative debt spiral where you can't dig your way out because the cost of servicing the debt is always more than economic growth. And what's worrying about this chart is that it shows you that the cost, the yield on a 10-year treasury is now converging to, the growth rate for nominal GDP, not real, but nominal. And so this is something that I think investors are going to they've already started to worry about a little bit. And this is something that, could continue to be an issue in the years ahead.
Do you see that in the investments in the U.S. stock market?
Well, I mean, I think right now people, there's this huge boom in AI that we were talking about earlier. Right?
Aside from the Nasdaq, I mean,
I think it's more an issue for bond markets. Their term premium have already been rising in the U.S., even though the Fed has been cutting rates, and the reason probably is because investors are a little bit worried about the fiscal trajectory. Depending on, there's different numbers out there. The commission is forecasting the U.S. fiscal deficit to widen to, I think, 7.8% of GDP in 2026 and 27. And that is going to push debt to GDP from 120 to about 130%. And it doesn't seem like there's much political will in the United States to take the kind of adjustments that Willem was alluding to that have already been undertaken in countries like Greece and Spain, and even Italy. Like, Italy comes in for a lot of criticism, but Italy's been running a primary surplus for years. And this is something that the United States is not anywhere near to, and is difficult, right? Because regular citizens don't like seeing their services get cut. They don't like seeing their taxes go up. But at some point, if you have nominal growth below the cost of how much it costs to borrow, you're going to have to take some painful medicine.
Yeah, I'm just looking on the other screen on the overall development of the stock market today. Yesterday, everybody was looking for the numbers coming in from NVIDIA, and we said that's a little bit of a different situation, or we should take that out of the analysis of the overall economy. But there's definitely, with the exception of Google, more red than green in today's
That's
market.
right. That's right. The equity market performance in the U.S. has been concentrated in the Magnificent Seven stocks, and outside of that, equity performance hasn't been that great. And maybe it's also worth making another point here about the economic impact of tariffs, because tariffs are a tax, and that makes foreign goods more expensive for U.S. firms and households. And this is just going to weigh on U.S. economic growth because you're taxing imported inputs that are used for production, and you're eroding the purchasing power of wages. And so the main negative impact from U.S. tariffs is actually on the U.S. economy. And so not only does it slow the economy, but they're not big enough. The U.S. economy isn't open enough. It doesn't import enough stuff for tariffs to actually replace other sources of taxes. And if you look at the federal budget in the U.S., the revenues collected from customs duties aren't even going to cover the cost of all the tax cuts that were just enacted in the One Big Beautiful Bill. And that's not even talking about aging demographics and the pressure that's going to put on Social Security and Medicare and things like that.
Yeah, I mean, I also quickly looked at the Russell 2000, also down today. But on that note, how is the Mittelstand doing, Willem? Did you get any sentiment from that?
Yeah, so the Mittelstand in Europe, I didn't really get a lot of sense, to be honest. I mean, this forecast is rather about the overall economy, where it's heading. So, I mean, I don't want to say anything on that. I cannot kind of support, except for going back to what I said before, that those that are focused on exports and like Krone trailer builders, they see the impact, right? I mean, so they see the impact of these, not just the tariffs, but what is coming on top. And what we are doing in Europe is trying to make their life easier. So, for instance, if you look at this simplification agenda, just to say how much of a change of mind, if you would have gone blind on saying what did the European Parliament demand from in the trilogue, right? I mean, so we have these European institutions coming together to set up legislation. And what did they demand when it comes to reporting requirements? Actually, they're on the side of reducing reporting requirements.
Yeah.
So it is the overall simplification that should actually benefit small and medium enterprises. But I mean, I haven't spoken to them, so I can't answer or give you a proper answer on that. Sorry for that. Next time I'll go and see some of them.
Okay, good. Yeah, we had this conversation, or Roberta Metsola mentioned that when we had her in New York for a presentation. She said that her first goal was to really make it easier to do business in across Europe. I want to get back to Ben for a second. I mean, we are, I mean, we all know the raison d'etre of the EACC is to encourage transatlantic trade. So we need, the US needs a stable Europe, and Europe needs a stable US. How worried are you about the fiscal deficits in the US for, putting your European hat on?
Well, I mean,
I'm worried about.
Yeah, I think it's worth worrying about. I mean, it's a very solvable problem. Like, I don't think that it's the kind of the fiscal trajectory is fixable in the United States, but it's, as I was saying, it's something that is politically difficult, and we don't seem to be at the moment where the political will is there to make the necessary tough choices. And I think that that is one of the main contrasts right now between the US and Europe, is that if you look at the slide right now that is talking about downside risks and upside risks, I feel like Europeans have internalized the downside risks. They're known. And yes, trade policy can continue to discourage growth. There could be more geopolitical tensions. You never know what kind of shock is going to hit, or in fact, you do sort of know what the shocks are. But because the shocks are the negative risks are sort of known and are understood, it's also an opportunity, right? And so, in fact, there's upside risk to the forecast. Because it's so clear that we're in a new world, I think that the EU has a relatively clear roadmap. There is some political will to make the kind of somewhat painful structural reforms that were outlined in the Draghi Report Willem was always already talking about streamlining regulations, other things like deepening banking and capital markets union. We could talk about that. But there's underlying all this is like unleashing greater productivity, more opportunities for investment, more opportunities for businesses and investors to make money. And I think that that's in terms of like the political where we are. I think there's more openness to making the kind of reforms that need to happen in Europe right now.
Yeah, I think, I mean, especially the domestic, the political uncertainty is really bringing countries together. I mean, everybody is there to, or is showing up to show support. Growth map. What's the forecast on that in terms of the GDP growth? Who of the two of you wants to take that?
This is just to show that growth is improving and that it's pretty broad-based, right? You're seeing, particularly in the core Germany and the related supply chains in Central Europe and Eastern Europe, growth is improving. And the reason that you have a slowdown in Ireland is just because of how much front loading of pharmaceuticals there was in the first half of pharmaceutical exports there was in the first half of this year. But I think maybe I should go to the final slide, because I think that the main point here is that confidence is returning. And but yeah, Willem wants to jump in.
Because there's one of my favorite maps in the report. It's not here, but I really recommend that people look at it, because if you look at what you see here, the outperformers are almost to the east. Not well. I mean, there seems to be a bias towards the east, right? But colleagues also made calculations on the impact of the Russian aggression against Ukraine, and then actually it's also these countries that have been impacted the most. Just imagine that where we would have been without that Russian aggression, and what would happen if this calms down, right? So just to say that if you're looking at the different countries and within Europe, the member states and the regions, there's still a lot of potential. Also, as I wouldn't say a major upside risk, but there is of course an upside to the story, that is less geopolitical risk and uncertainty. Yeah, I just wanted to add that before you go to the next slide, Ben.
Yeah,
and
absolutely.
Once the war is over, we can all spend money on rebuilding Ukraine.
That will have to be. That will have to be. Yes.
Confidence is returning. That's a good thing, because if people are confident, they spend money. They invest.
Yes. So, I mean, just to explain what these charts are, the one on the left is indicators for non-financial EU corporations, so regular companies, but not banks and mutual funds and pension funds and things. Basically, what it's showing is that their leverage has fallen, so their balance sheets are increasingly healthy. Their interest payments on their debt have leveled out. Earnings are growing, and borrowing costs are falling. So for regular non-financial EU firms, easier financial conditions and strong balance sheets are point to the ability to continue borrowing and continue growing in the years ahead. And all of the public investment is going to jumpstart, because I mean, when you build a new highway or a new road, you need to hire firms to do the construction. And so that's happening. And I would also add that, like, a lot of when you hear that there's like public investment is increasing and more RRF money is being dispersed and things like that, these projects actually take years to play out in many cases. So the benefits from the higher spending on defense and infrastructure and energy independence, these are going to be running 26, 27, 28, 29 in some cases. You've got multiple years where this is going to be a tailwind for growth. And to give a sense of like how far Europe has come, the chart on the right shows sovereign spreads over German bonds for a variety of other countries, and in particular, Portugal, Greece, Spain, Italy. 10 years ago, when I first started working for the EU, we were still in the midst of the European sovereign debt crisis. You know, Greek spreads were through the roof. People worried about it all the time. Like, is Greece going to be kicked out of the euro? And the answer was no, of course, that's not going to happen. Europe is going to do whatever it takes to maintain the single currency. And now we're finally back to a place where spreads have converged. Um, and that filters through to borrowing costs for corporates, because you know the sovereign spreads are the benchmark, and so yields come down there, borrowing costs for Italian firms go down as well.
Yeah. We only have 5 minutes left, but I would like to address, I know we have one more slide, but I would like to address, so what Europe is doing next. Strategy on, you know, for the, you know, to build on this for the next, you know, couple of years. Investment, structural changes. We don't have a lot of time to get into all the ins and outs of the savings and investment union, but can we just kind of go through a couple of points that you know, give our American friends a better understanding of where we are taking it from here now that we're on this upward trajectory?
Sure. Just maybe I can make 2 points on capital markets union, which I think that particularly for an American audience, like, you shouldn't expect there to be like a big bang of suddenly there's like a totally integrated capital markets union in Europe that looks like the United States. It won't work like that. What you're going to see, and what you're already starting to see, is like steady incremental progress towards deepening capital markets and making them more harmonized and more efficient. And one example that I would like to cite is the recent Dutch pension reform, where in the Netherlands they are moving, I think the cutoff date is January 28, where they're moving away from defined benefit pension schemes to defined contribution schemes. So more like what we're used to in the US, with everyone having 401ks and every month putting aside a chunk of your paycheck to go into a mutual fund that then buys stocks or buys corporate bonds or whatever it is in financial markets. The Nordics have basically already made this change, and other European countries are increasingly going to think about making reforms to their pension systems that move in this direction, that provide liquidity for capital markets. It's not going to happen overnight, but it's going to happen slowly over the coming years as people see how the experience of the Nordic countries and the Dutch has worked, and demographic pressures provide a political incentive to do this. So that's going to happen. The second thing I want to mention is securitization. There's going to be more EU level oversight of the securitization market, more harmonized rules. The Commission has a proposal out now. There's a political process that has to go through the Parliament and the Council, but these things are happening. Don't expect a big bang, but steady incremental progress in that direction. And maybe Willem has some things to add as well, because he's Dutch after all.
Well, I'll leave the Dutch pension system to you, Ben. I think you have more of a bird's eye view than I do, with still some stakes in there. No, I just wanted to, you know, to mention three things actually when it comes to this, and I won't come back to the simplification agenda. But first of all, of course, the big money, the MFF, 2028. The discussion is right now coming to fruition. It needs to close to boiling point with a huge overhaul of this budget, this multi-annual budget for the EU, with increased ambition and a restructuring of the way the money is spent, where it's also clear that there will be more tighter control on performance. So to say, so it will be linked more to performance. But just two concrete examples. First of all, one from the Commission, and secondly, one from the Council. The Commission, so that is the member states themselves. So from the 28th regime, so this is an idea that you can have an incorporation for the European Union as a whole. So so instead of 27 different incorporations, you would now have a 28th regime, and there is a huge discussion, and this will come. There will be a proposal by January 2026. So that's really looking forward to that, and that should really help. Is it always the European Commission? Yes, well, the European Commission should be in the lead, but there's also the member states. And there are 20 ministers of finance, which are actually working to make the Savings and Investment Union, the capital market, one capital market happen by a portable financial title, which is Finance Europe. So so that's 20 member states. So there is kind of a idea of, they'll bring it first, and then others can jump on board as they see fit. When they see, and this is of course what you've seen before. I mean, you just need to type in Bulgaria 1st of January 2026, and it's not where's the best party in Sofia, the best New Year's party in Sofia, but it's about the introduction of the euro, and which is another example of a successful EU project where many people first doubted whether we would ever get there. We've gone through difficult times, as Ben also alluded to. But the spreads are now at the lowest level since 2007. So there's a huge compression. That also means that there is also a huge burden on the EU to make it happen. So there is still need for ambition. Yeah.
Very good. On that high note, it's 2:02, 2 minutes over. I think there was a very, very interesting discussion. And it's good to see that Europe is back and kicking. And I would like to thank again our panel, Ben Carlina, Senior Economist at the EU Delegation, and Willem Kooi, the Counselor for Economic and Financial Affairs, his colleague in Washington. And we will have this webinar up on our website and on our YouTube channel and promote it to the folks who have been able to join us today. And thank you again for listening. And we see you at our next event. And, look forward to talking more about transatlantic relationships. And we have a whole slew of topics that relate to strengthening the ties between Europe and the United States. There's a lot happening that you're not reading in the news. Collaboration on the corporate level, and I'm getting more and more evidence. It was a couple of weeks ago, it was just anecdotal, but companies between Europe and the US, mid-sized companies, but also large companies, are working together like and they've never done it before. So I'm pretty bullish on transatlantic relations. So thank you, Willem. Thank you, Ben.
Thank you, Yvonne. My pleasure. It's always a pleasure. Let's hope we were again too pessimistic.
Yeah, let's hit that 3%.
Yeah, exactly. Yeah, it's never going to be like growth, but that's a whole different conversation that we need to have. Yeah. But no, it's very good. Very happy.
All right. Thanks very much.
Thank you.
Thank you very much. Great to be here.